Well, good morning and welcome to the Plato webinar. For those of you who don't know me, my name's Mark Cormack from Pinnacle Investment. Pinnacle are equity partners and work alongside Plato to distribute Plato's Australian and global income funds to the Australian financial advisory marketplace. And today I'm joined by one of Australia's leading experts in the world of equity income, Plato's Managing Director, Dr. Don Hampson. For our webinar today, we're going to provide an update on the Australian equity income market, specifically looking at reporting season, and in addition, with the ALP's proposals to remove franking credits for retirees and SMSF investors firmly still on the agenda, we'll provide an update there. As a bit of background, Plato has almost been unique in the Australian retail advisory marketplace as one of the very few managers who fully assesses the after-tax implications on their investments. And this has resulted in the Plato team developing a high-yield equity income solution for both Australian and global equities. And because CGT is no impediment for low-tax investors, Plato actively rotates through dividends to deliver high income in Australian equities around 9% per annum and global equities around 6%. But before we kick off, just a couple of quick housekeeping items. Today's Plato presentation should last around 15 to 20 minutes, and that'll be followed by a Q&A session. All attendees do have the opportunity to ask questions, and that can be done by clicking the questions tab on your screen. So without further ado, I'll hand you over to Plato's Managing Director, Dr. Don Hampson, for today's presentation.
Thank you, Mark. First, I'd like to update listeners with the ALP franking credit proposal. Hopefully, many of you have received this week an email asking you to fill out a survey because we are surveying clients. What has happened is that the government has actually done something. They have called a standing committee for economics inquiry into the franking credit proposal by the ALP. And just for anybody who may have been on holidays for the last 6 months, what is this proposal? It's a proposal to eliminate the net refund of franking credits to Australian investors, although charities, endowments and pensioners are exempted from that. But if you're in a self-managed super fund or you are an individual who might be low income and is currently receiving franking credit refunds but you're not a pensioner, then you would stand to miss out on those franking credits. I think it's important to note there is a bit of fake news and a bit of hyperbole about this. Franking credits will still exist, they will still be there, and you can still use franking credits to offset tax payable. The only thing about this proposal is that one's back at changing the rules in 2000 where you can actually get a net refund of franking. You can no longer get a net refund, but let's say you had $10,000 worth of franking, but you had $10,000 worth of tax payable, then the franking can be used to pay the tax. But if you had $12,000 franking and $10,000 tax payable, you wouldn't get a refund of the $2,000 excess franking under this proposal. So that's where we're at. There hasn't been any changes. The ALP have basically said they've exempted now pensioners, but they're not going to make any more changes. As I mentioned, the latest news here is that there's a House of Representatives inquiry into this. We should say at this stage that whilst I think it's quite likely the ALP will win the next election, this is not a fait accompli. Even if they win the election, they will need to get it through Senate, and I think this will be quite hard to get through Senate, as we've seen with company tax cuts for the Liberals who couldn't get it through Senate. I think essentially, as I call it, robbing granny in the name of Paul, taxing self-funded retirees isn't the most popular thing, and people such as Pauline Hanson have come out and said they're not in favour of it. So I think it'll be quite hard to get through Senate, so it may never come to pass. We certainly encourage people, though, to get behind it and send a message to Canberra. Happy for you to continue to add your names or clients' names or colleagues to our petition, and also to complete our survey. We have done some research. We announced since our last webinar a new piece of research, and this is interesting research, I think, because this slide here highlights some work we did, some modelling work on which super funds might actually lose franking credits. And whilst everybody is focused on pension phase self-managed super funds, who are obviously in the firing line of this, our work and also that announcements that have the Australian made dug into the tax records and found that there's actually quite a few other APRA-regulated funds, potentially retail funds, industry funds, government funds, that may miss out on franking as well. And our research suggests that any fund that has sort of 50 to 70 or more % of their members by dollar value in pension phase potentially may lose some of those franking credits, and the maximum loss will be if all your members are in pension. But even if you have 80% of your members in pension phase, you'll probably start to lose some franking. And indeed, if you've got a high level of franking in the first place, you might actually start losing franking at 50%. So it's not just pension phase self-managed super funds. If this proposal comes in, I think as planners, as financial advisors, you'll actually have to ask the question about whether your retail platforms, if you use them, are able to provide the full refund of franking credits. Because some of them, I believe, may not be able to. Now, as I said, there has been a standing Committee on Economics Inquiry. This is a House of Representatives committee. It's on party lines, so it's chaired by a Liberal. They're looking at inquiry into the implications of removing franking credits, who's impacted and the implications for change. We would encourage you to consider providing a brief submission to this standing committee. Submissions are due by November 2nd. If you look at the link there, we put the link to this inquiry, and we will definitely be making a submission, and it's one reason why we've done our survey, to help answer some of those questions. But I think the committee will be very interested in individuals who will be particularly affected, and in our view that will be low-income non-pensioners, and I put my own mother in this situation, although she has passed away, but she was a self-funded retiree, but she didn't have much more assets than and just missed out on the pension, but she didn't earn a huge amount for her investments, and the franking credits were at about 30% of her income. So if this were to come into place, you would have lost 30% of her income, and you think losing 30% of your income is a huge amount of money for someone who's retired, is certainly too old to go back to work, and this will really impact those people. And so individual stories of hardship, I think, of how people will be affected will be looked on quite positively by this inquiry. So you may want to think about providing some case studies of some of your clients who would be impacted. So that's it on the franking update. We're certainly out there still rattling the cages. In terms of dividends, you might think it's all doom and gloom, but the dividends just keep on coming in the August reporting period, and it's a month or so back now since it's finished. But our analysis of S&P 200 companies that reported during reporting season, that's about 65% of the index report in August by value. That's nearly 70% of, not quite, but nearly, sorry, it should be nearly 70% of companies increased dividends. About 15% were the same, and slightly under 20% cut dividends. From a average increase perspective, the average increase in dividends was over 11%, nearly 12%. Averages can be a little skewed though, because you had a few companies that reinitiated dividends, so they effectively went up 100%. There was quite a few large ones. So if you look at the median increase was about 6%. So that's a reasonable sort of year-on-year comparison. And it evaluated, because a lot of the big miners like BHP and Rio had quite large increases in dividend. If you actually weight by the value of the companies, or the index weight of the companies, that increase was actually nearly 18%. But I think that there were, to some extent, look at BHP, it's actually just got back now to where it was 2 years ago when it cut its dividends. So it was sort of getting back to usual. Interestingly, we've done some numbers globally. We haven't actually put them on a slide, but we saw similar numbers globally. If we look at the September quarter and compare it to September quarter last year, there's about a 6 or 7% increase in dividends in common currency, but actually in Australian dollar terms, with the Australian dollar going down, the increase in dividends is about 13%. So that currency has actually helped increase those dividends. So whilst in common currency it's about the same as the Australian dividend increase, in Australian dollar terms, global firms increased their dividends by about 13% September quarter on this year versus September quarter last year. So that's a very encouraging increase in dividends, and we've had probably slightly higher increase actually in the distributions out of our fund. Our Global Income Fund has had a similar sort of uplift year on year in quarter on quarter. In terms of some of the individual stock stories, I've already mentioned that quite a few of the big resource stocks had some large increases, so the likes of Alumina, BHP, Rio, or BlueScope's a steel producer but still in that material sector, some very big rises there. And one for fund managers, etc. Magellan increased its dividend by 91%. And it's interesting, and I think this may be a feature we'll start to see not just domestically but globally, is stocks like Magellan, and I suppose we're a fund manager as well, fund managers don't need to have a lot of capital. Our investment's really in people. We don't invest in huge amounts of plant equipment and buildings, etc. We lease our buildings and we have some computers, or we might use cloud computers or what have you, but we don't actually have large investments. It's mainly people. And so they recognise that by increasing their dividend payout ratio dramatically. And we think a lot of new age companies may actually be able to, like service-oriented companies, may actually be able to significantly increase their dividends. So that's sort of something to watch. Obviously, still a lot of woes around Telstra and a big vote against their remuneration in the last day or two. They cut their dividends, but this has been well flagged by 29%. We actually don't even count their special dividend, and so on our numbers, so the numbers that we portrayed there in terms of the size of the increase in dividends, we actually assume only look at the ordinary dividend of Telstra, and it actually was down 50% if you exclude the special. But that to us is a sign that Telstra may actually not pay that special in the future at some time. AMP, obviously a lot of woes in the financial services area, and Royal Commissions and things cut its dividends by 31%, but it's been a stock that we haven't owned for some time. And against the grain, Fortescue, and this has been a common theme for the last year or so, Fortescue cut its dividend by 52%, because it's a bit different to a lot of the other producers, particularly it's an iron ore producer. Its iron ore quality currently is substantially lower purity than the likes of BHP and Rio, and the difference in prices between high quality iron ore and low quality iron ore has been at a sort of historic high, the gap between the two, with low quality iron ore being sold quite cheaply relative to premium high grade iron ore of BHP and Rio. Having said that, Fortescue is moving to try and improve its grade. Summing it all up, there was actually, and even if we didn't even allow for that the special on Telstra, the market dividend yield actually slightly increased overall when you work out by market cap, and that was only from 65% of stocks increasing their dividends. Another feature that we saw more recently is Rio announced a buyback. Now Rio and BHP both have between them the two largest franking account balances of all companies in Australia, and it's good to see Rio paying some of that franking balance back out to shareholders. So Rio announced a buyback. This is an off-market buyback. The terms are roughly that they will, or investors, shareholders can tender their stock into the buyback at up to a 14% discount. We would expect this Rio buyback to go off at the maximum discount of 14%, and the numbers in this chart are based on a 14% discount. We've used September 21 prices in doing this analysis. Obviously the market's moved a little bit since then. But the buyback will be by way of a $9.44 capital amount, and the rest of the buyback being a cash dividend. Now, this isn't what the actual buyback will be, but this is based on September 21 prices. We have a note on our website on this. But it'll be worth about 17% more, like $93 based on those prices, if you sold into the buyback versus if you got a full refund of the franking, so this is for a tax-exempt investor, versus if you sold in the market on September 1, you would have got around $80, so you would have made about $13 more, which is a fairly substantial premium. So it looks good for tax-exempt investors. Unfortunately, when they look really good, a lot of shareholders will participate, and we think there'll be quite a large scale back, as there has been in similar. Rio's done 2 other buybacks, and there have been large scale backs. So it's good for what you can get, but you won't get all your shares accepted unless you only have a small holding. So that's a quick update, and I'll hand back to Mark, and he may have some questions.
Excellent, Don, and always fascinating to hear your views on income investing, specifically for low-tax investors. Just a reminder, all attendees do have the opportunity to ask questions via the internet, and this can be done by clicking that questions tab on your screen. Look, while we wait for some of those questions to come in, I might just reiterate a couple of points on Plato's approach. Plato is specifically designed for low-tax investors such as retirees, and has been able to deliver a high-income solution in Australian equities, delivering 9% per annum income since inception, and global equities around 6% per annum income, which is quite unique in the global equity space, where most global equity income funds will deliver around what the index delivers, which is around 2%. We have had a couple of questions come in just with respect to some of the points that, Don, you were talking on. Plato, in terms of your view on Telstra, has this changed with the telco market becoming a little less competitive with the merger of TPG and Vodafone?
Well, clearly it's taken one of a number of negatives off the table, and so we've sort of seen a little bit of a correction, which I think has factored in that change. So we've seen a little bit of a bounce in the Telstra share price, but I think that's now reflected in that price. I still think it's a tough outlook for Telstra, and I'm fairly certain, although you never be fully certain in this game, that Telstra will probably have to cut its dividend in the foreseeable future as the NBN payments roll off.
Excellent, Don. That covers a couple of questions. Got a few more questions I'll try and combine into one here. Do you think the banks and insurance companies may need to reconsider capital positions in the like of any franking changes, and your outlook on banks' dividends and financials dividends in the light of things like Royal Commission and growth?
Well, clearly, we haven't seen the finish of the Royal Commission, although the interim report has come out, and to some extent it wasn't as bad, I think, as people felt, and we didn't see a sell-off in banks or a bit of a rally actually at the time. Clearly, there are still headwinds for the banks, and I think I saw a number yesterday. Someone had toted up that the banks are going to have to pay about $1.3 billion back to shareholders in terms of sort of recompense for fees that were charged that shouldn't have been charged, etc. And $1.3 billion looks like a fairly large number. On top of that, you've got all the legal costs and other things associated with that. But I think you need to put that into perspective. The banks earn something in the order of $30 billion profits per year. $1.3 billion, yes, is a reasonable number compared to that. But this $1.3 billion is really a cost over 5 or more years. I mean, we're talking about the bad deeds that have been done over a number of years, and if you divide it by 5 and say, on an annual basis, it comes out to something sub $300 million across all the banks, compared to $30 billion or more of profits, and that actually is like 1%. So it's actually, in terms of when you compare it over the relevant time period, this is actually a fairly marginal cost. I mean, I think the management's time on it's probably been more important than the actual costing, in which case I think most of the banks can probably get by without having to cut their dividends. I mean, you've seen CommBank actually slowly increase its dividend, albeit quite small, even though it's had AUSTRAC fines. It's actually had a lot more pain than the other guys given the AUSTRAC issue, and it's still actually maintained or slightly increased its dividend. So I think the banks potentially can, maybe one or two of them might have a small cut, but I don't see that as being significant.
So, Don, you see probably the most of the total return you're going to get at banks is going to come from income rather than growth?
Yeah, although, I mean, banks to us look pretty cheap. I mean, their multiples, compared to the rest of the market, they look pretty good value. So we do think there are certain areas of the market, on the other hand, that look very expensive. They've come back to the ground a little bit. The likes of CSL, etc., have come back a bit in the last month or so. but they still look very expensive relative to history. They're the growth stocks, and they should trade on a higher multiple, but not quite the not the multiples that they have been trading on. So, in a relative basis, we think the banks look pretty attractive. So it may be that they might actually have some capital growth to catch up with the rest of the market once we have the final dust settles on this Royal Commission. But we need to see what the end results are, what the politicians do. But at this stage, to me, the first interim report said basically you don't need new laws, you've just got to police the laws we've got. So I think that's probably a good outcome for the banks, I think.
Okay, Don, wrapping a couple of questions into one here. Australian residential property, can you see SMSF's increasing exposure to property if franking credit policy comes into fruition, and rising interest rates? What's your view there?
Well, look, I don't want to call the residential property market, but clearly in Sydney and Melbourne, it has rolled over and prices are falling. And, the reason a lot of people go into, especially residential property, is either you need a house or you expect the prices to go up. And if they're going down, you don't get a lot of rental income out of property. So I think you want to be slightly cautious about that. I don't want to recommend it either way, but it's the property market is linked to interest rates. They're at record lows at the moment, but the expectation is that they'll slowly rise over the next 5 years, albeit it will be very slowly. But clearly, if the ALP get in, if they are able, and again it's an if, can they get this proposal through Senate? I think that will be very hard. Then if it comes in, then clearly if you lose franking on Australian shares, you might say, well, other asset classes look more attractive, be it property, be it global shares, etc. At the moment, cash doesn't look attractive at 1.5%, but I think people will actually diversify a little away from Australian shares if they haven't got that nice franking credit to add extra income.
Okay. In relation to franking, what could franking credit proposal mean for things like hybrids, Don?
Well, I think that would be a fairly big question mark over hybrids if a lot of the ones that are fully franked hybrids, clearly you value the franking credits when you determine the yield. So either the yield will have to go up on those things, or banks might look to use other methods to raise capital. So that's certainly an area that would have to be looked at quite finely if this proposal comes through. Mm-hmm. Having said that, as I mentioned before, it's only really, I suppose, some superannuation funds and some retirees who will miss out on franking. Individuals will still get franking credits and can offset them against tax payable. Tax exempts can still get franking credits. Pensioners will still get franking credit refunds. So there is still a lot of the market will get those franking credits. It's not like everybody loses them. And indeed, if you take into account a couple of other things that if the ALP get into power, is that they're looking to reduce the discount for capital gains, so capital gains will be taxed more highly, and they're also looking to get rid of or reduce the scope for negative gearing. So there's an interesting mix when you look at three things together: the potential watering down of franking, potential increase in capital gains tax, and potential stopping of negative gearing for new assets, or I think old property is what they're looking at. Then you've got to put all those things into perspective, and it may be that shares still look attractive for a lot of people. In fact, on our numbers, high tax investors may actually have more of a preference for fully franked dividends going forward because they can use those franking credits to offset tax payable.
And Don, let's say worst comes to worst and this does come in, would Plato look at changing the current strategy? We keep the same fund and potentially look at another specific fund? Well,
because a lot of the current investors in that fund, we have quite a few $100 million of tax-exempt charities and foundations. Yep. We have a lot of people on platforms and things that probably still get the franking credits. I know there are individuals who have $50,000 or $100,000 in that just to supplement their pension, their pensioners, and they put a bit of their, they've got $100,000 or $200,000 in investment, so they actually still will get the pension, but they get some nice income out of that fund. They'll still get the franking. So we won't be changing. We don't believe anyway. We have to look at what actually happens, but we don't believe we'll change that fund. But it may be that we might want to consider an alternative fund for people who can't use franking credits. But given a lot of the current investors in that fund will be in exactly the same position as they are now, we're not going to change it.
So potentially a new fund
Possibly, yeah.
Don, more in regards to tax-effective buybacks and franking, could you see more companies do what Rio's doing in terms of buybacks? And if it did look it was going to come into fruition with the franking credit change, could you see a short-term spike in income payments because of buybacks or special dividends?
Well, quite possibly, although the caveat there is that you need to have the cash to pay the dividends. So, one of the reasons that Rio has been able to do this is it's been selling assets, like coal assets. BHP's in the process of selling its US unconventional gas, so it will probably be in a position to have excess cash and excess franking. So I think there's a reasonable chance they may do a buyback in the near future. And they're the two biggest franking account balances. Other companies that have large franking account balances include Woodside, Woolworths, Harvey Norman as a percentage of its market cap is one of the bigger ones, Caltex as well. So, but you do need to, have the cash to be able to pay the dividends. And you've got to look at those individual circumstances. But certainly I think BHP is quite likely to do it, and we'll certainly encourage companies to flush out as much of the franking as they can before this came into being, if it ever does come into being.
Final question, Don, running out of time. The outlook for global income versus Australian income and this franking credit thing, it probably makes global equities more attractive, and if you're delivering high income like you guys are, it's...
Certainly I think a lot of our clients have reconsidered global equities, and particularly in light of the fact that we've been delivering consistently sort of 6% income out of global equities, that it can provide good income. And if there were, say, threats to the imputation for some investors, they probably are over-invested into Australian shares, and possibly because of that franking. And if the franking is lost for some investors, we would expect them to potentially put more in global, where they really should do it anyway, just from diversification benefits. We've seen strong returns out of global in the last year or two, with the Australian dollar being a bit soft, and that's a benefit as well.
Don, we have got through all the questions, so we'll wrap the presentation up there for now. We will be making the webinar available on the Plato Investment website later today, and that's www.plato.com.au. I'd like to thank everyone for their participation today. It's always great to host these webinars with all the questions that come in. If you have any further inquiries, I'd certainly encourage you to contact the Pinnacle distribution team, who you would have seen on the slide there. I'd like to thank you for your time today. We look forward to speaking with you either in person at your office or at our next webinar or luncheon. Many thanks, and have a good day.